Have you ever thought about this? How can two investment funds holding the exact same stocks end up with completely different tax bills for their owners? It seems kind of crazy, right? Well, today we're going to pull back the curtain on a really clever, and some might even say controversial feature inside exchange-traded funds, ETFs. And this one little secret has a huge impact on your portfolio's bottom line. So yeah, this is the central mystery we're going to solve together today. Picture this. You own a mutual fund, and your friend owns an ETF. Both of them are just tracking the S&P 500. So you hold the same stocks, you get pretty much identical returns. But then, how is it possible that at the end of the year, you get hit with a surprise tax bill and your friend gets nothing? The answer is just fascinating. And it's all buried in the fundamental design, the very architecture of how these funds work. And look, we need to be clear about something. This is not some tiny niche financial quirk we're talking about. This is a massive part of the investing world. I mean, look at this number. By 2035, assets in ETFs are projected to hit a staggering $35 trillion. That's probably going to blow right past the amount held in traditional mutual funds. So this tax difference, it isn't just a small detail. It is one of the key reasons we're seeing this huge shift in the market.
Okay, so to really get why ETFs are so tax efficient, we first have to understand the problem they were basically designed to solve. And it's a really common and, let's be honest, an incredibly frustrating experience that millions of mutual fund investors have had to deal with.
Just take a look at 2022. It was a rough year for pretty much everyone, right? The S&P 500 lost over 18% of its value. And yet, during that same painful year, 42% of active mutual funds still handed out capital gains distributions to their shareholders. I mean, just let that sink in for a second. Your investment went down in value, but you still got a tax bill. It's wild. Now, on the other hand, the vast majority of equity ETFs, they distributed no capital gains at all. So why does this happen? Well, it's because when other investors in your mutual fund want their money back, the fund manager has to sell stocks to get the cash to pay them. That sale, happening inside the fund, creates a capital gain that gets passed on to everyone who's left, including you.
ETFs, though, they have this brilliant built-in workaround that almost completely sidesteps that entire problem. And this, right here, is where the magic happens.
So to get how this works, you've got to know about this key player in the background, the authorized participant, or AP for short. The easiest way to think of an AP is like a wholesaler for ETF shares. These are huge financial institutions, big banks, and they have a special deal that lets them create and redeem massive blocks of ETF shares directly with the fund itself.
All right, so here's the crucial part. It's all about how these APs operate. Let's say a ton of investors are selling their ETF shares on the market. An AP will step in, gather up a huge block of those shares, and take them back to the ETF issuer. But here's the kicker. In return, the fund doesn't give the AP cash. It gives them the actual underlying stocks from the fund's portfolio. This is what's called an in-kind redemption. And because no stocks were ever sold for cash inside the fund, there's no taxable event created for the people still invested. The whole tax problem just vanishes.
And you can imagine, this has some absolutely incredible benefits for you, the long-term investor. When that fund manager is handing over stocks to the ASP, they don't just pick randomly. They can strategically choose the shares with the lowest cost basis, the ones that have the biggest built-in gains attached to them. So this process literally purges those potential taxes right out of the portfolio. It lowers the fund's overall unrealized gains, and at the end of the day, it gives you way more control over when you actually pay your taxes.
But wait, it gets even more interesting than that. This feature, which is kind of passive by nature, has been turned into a powerful, active strategy. Some people have even called it one of Wall Street's biggest and maybe dirtiest little secrets.
This quote from Bloomberg really signals a shift in what we're talking about here. We're moving beyond just the standard built-in tax efficiency of ETFs. We're now diving into a much more deliberate and, for some people, a much more controversial maneuver. It's called the heartbeat trade.
So the tool that really unlocks this power is something called a custom basket. Now, normally, when an AP redeems shares, they get back a representative slice of everything in the ETF. But a custom basket, well, that lets the fund hand over a very specific targeted group of stocks. And this capability, it's absolutely critical for what comes next.
And the reason it's called a heartbeat trade is because of what it looks like on a chart of the fund's daily flows. You'll see this normal, everyday activity, and then all of a sudden, bam, a massive inflow of money on one day, followed by a nearly identical massive outflow just a couple of days later. It looks just like a heartbeat on an EKG monitor, a big spike up and a big spike down.
So,
What is actually happening here? Well, it's a coordinated trade. An AMP will inject a huge amount of money into the fund. Then, just a day or two later, they pull it all back out. But, and this is the whole point, when they redeem, they don't get a normal basket of stocks. They get a custom basket, filled specifically with the stocks the fund manager is desperate to get off the books. Think about shares in a company that's about to be acquired, something that would trigger a huge taxable gain for the fund. In effect, the ETF gets to wash its portfolio clean of its biggest tax headaches.
And the scale we're talking about here is just immense. A recent study looked at just the top 25 equity ETFs for one fiscal year. It found they had realized $208 billion in gains using this in-kind redemption process. And the amount of capital gains they actually passed on to the shareholders? Zero. Not a penny.
Okay, let's look at a real-world example to make this super clear. Back in 2018, the agricultural company Monsanto was about to be acquired by Bayer. Now, that kind of deal would create a massive taxable event for any fund holding Monsanto stock. So right before the deal closed, a Vanguard fund did a heartbeat trade. An AP pushed $1 billion into the fund. Then, a few days later, they redeemed that billion. But in return, they got a custom basket that contained almost all of the fund's highly appreciated Monsanto stock. And just like that, poof, the massive taxable gain was surgically removed from the fund's books.
So this mechanism is, without a doubt, a really powerful financial innovation. But its sheer effectiveness has also placed it right at the center of a pretty big debate about fairness and tax policy.
All right, so let's do a quick recap of the key differences here. When investors want their money back, a mutual fund has to sell stocks for cash, which creates a tax event for everybody. An ETF, it uses that tax-free in-kind exchange. This is why capital gain distributions are so common for mutual funds, even in down years, but they're super rare for ETFs. And when it's time to rebalance the portfolio, a mutual fund creates taxes by selling, while an ETF can actually use these heartbeat trades to eliminate potential taxes. The real bottom line here is that tax control shifts from the fund manager over to you, the individual investor.
Now, as you can probably guess, this huge tax advantage has not gone unnoticed. Recently, Senator Ron Wyden, who is the chair of the very powerful Senate Finance Committee, actually proposed eliminating the very section of the tax code that makes this all possible. It's Section 852b(6). And if that were to be struck down, it would fundamentally change the entire landscape for ETFs.
And that really brings us to the final and most essential question here. What is this really? Is it a brilliant feature that benefits everyday investors like you and me by giving us more control and letting us defer our taxes? Or is it an unfair loophole that gives one type of investment a huge government-approved advantage over another, costing the Treasury a ton of money in the process? You know, the answer isn't simple, and it's a debate that is absolutely going to shape the future of investing for decades to come.
You know, there's a pretty wild tax trick hiding inside your ETF that might just be saving you a ton of money. It's this structural advantage right there in plain sight. And today, we're going to pull back the curtain on how it works and what it actually means for your portfolio. So let me ask you this. Imagine you open your year-end statement. You see your investment lost money. But right next to it, there's a tax bill from the government. You're literally paying taxes on a loss. How is that even possible? Sounds completely insane, right? Well, it's a very real thing for millions of mutual fund investors. Okay, let's look at a real-world example. Take 2022. It was a really rough year for the S&P 500, which posted a negative return of 18.1%. Ouch! So most investors holding a broad market fund saw their balances take a pretty significant hit. And yet, get this. In that very same losing year, a staggering 42% of active mutual funds paid out taxable capital gains to their shareholders. Just let that sink in for a second. The fund's value went down, but investors still got a tax bill. And this isn't some weird fluke. It's baked into the very way that mutual funds are designed. And you can see the difference right here. It's huge. Year after year, ETFs distribute way fewer capital gains than mutual funds. Now, this is no accident. It is a deliberate, structural design feature that gives ETFs a massive tax advantage. So how do they do it? What's the secret sauce? Well, the first part of the trick is all about how you get your money out. It seems like a tiny detail, whether you're trading or redeeming, but it has absolutely massive tax implications for everyone in the fund. Okay, so here's the crucial difference. When you sell a mutual fund, you're selling it back to the fund company itself. To pay you, they have to sell stocks, and that sale triggers a taxable event that hits everyone still in the fund. But with an ETF, you're just selling your shares to another investor on the stock market, like any other stock. The fund itself isn't involved at all. So no sale, no taxable event for the fund. But wait, you might be thinking, what if there are way more sellers than buyers? That's when the ETF does have to get involved, and it's where this second really clever layer of tax defense comes into play. This is where a special kind of player called an authorized participant, or AP, steps onto the scene. You can kind of think of them as the wholesalers or the plumbers of the ETF world. They're the only ones who can create or destroy huge blocks of ETF shares, and they're totally essential to keeping the whole system running. And here's where the magic happens. When an AP wants to redeem a massive block of ETF shares, they don't get cash back. Instead, the ETF issuer just hands them a basket of the actual underlying stocks from the fund. No cash changes hands. And what does that mean? No cash, no sale, no tax. It's an elegant, in-kind swap that avoids a taxable event. But this whole in-kind process gets even smarter. It's not just about dodging taxes today, it's about strategically getting rid of potential tax bills down the road. ETFs can actually use this process to cleanse their own portfolio. So when that AP comes to redeem shares, the ETF manager can actually cherry-pick which stocks to give them. And what do they choose? They hand over the stock lots that have the biggest built-in gains, the ones they bought way back when for a super low price. They effectively export the biggest tax bombs out of the portfolio, leaving a cleaner, more tax-efficient fund for all the investors who stay put. Okay, but what about sales you just can't avoid? Like, what if a stock in the fund is getting bought out in a cash deal, or it's being dropped from the index the ETF is supposed to track? The fund has to sell, right? Well, this brings us to the most surprising, most sophisticated maneuver of them all. And make no mistake, this isn't some happy accident of the tax code. As one law review article points out, this specific provision is being actively and legally exploited through a highly coordinated play between ETFs and their authorized participants. It's called a heartbeat trade, and honestly, it's about as dramatic as it sounds. We're talking about a massive, short-term, coordinated flood of assets in and then right back out of the fund. It looks just like a single beat on a heart monitor. And it's how an ETF can get rid of a stock it needs to sell without triggering a taxable sale. So here's the play-by-play. Right before an ETF has to sell a stock with a huge gain, an AP comes in and contributes a massive amount of assets to the fund. They wait just a couple of days, then they redeem their shares. But, and here's the trick, instead of getting the standard mix of stocks, they get a custom basket that just happens to contain that one specific stock the ETF wants to get rid of. The result? The unwanted stock is gone, and the ETF sidesteps a huge tax bill for its investors. So after peeling back all these fascinating, kind of complex layers, what's the bottom line? Why does any of this complex machinery actually matter to you, the investor? It really all boils down to two things: control and efficiency. All of these mechanisms mean that as an ETF investor, you generally don't pay capital gains taxes until you decide to sell your shares. You're not on the hook for the actions of other investors. This seriously reduces that sneaky tax drag that's always eating away at your returns, which means your money can compound more effectively. And that, over the long term, is how you really build wealth. It's a really powerful, kind of elegant system, engineered for tax efficiency, hiding right there under the surface of a product so many of us just assume is simple. So now that you know about these hidden mechanics, does it change how you think about the structure of your own investments?